And we back. We back for the final week of July. Here to talk about this Australian dollar markets. We'll discuss the previous week and what we see for the future. What's some new potential targets we can see for the future? So we're basically looking at both situations, and we're going to talk about a little bit of trading psychology and what that all means and what does it entail. So first, before anything, we're going to set our margins, our previous daily high and lows, so we can at least see just at the bare minimum what type of targets we could be looking at for, like I said, the daily high and the previous daily low. So I like to do this every day pretty much. I get a new daily candle forming. I think it's like 4 or 5 o'clock. So around that time, I like to mark up my previous daily highs and daily lows. So we zoom in. This candle right here is the previous day. So this green level is my high, red level is my low. And as you can see, I already had it set for this day, which was the 19th. I think that was a Wednesday. Tuesday last week. So Tuesday, Wednesday, Thursday, Friday going into Sunday, which is this candle right here. So with that being said, we're gonna mark our highs. I'll move this. And honestly, I really think we going above this yellow line for liquidity, because if you look back on I think it was last week or the week before, 2 weekends ago, we had 2 bullish levels that I talked about, and you could pull up that video and see. One was already hit. I believe it was this high. If not, it was these two. These days right here, these equal highs. I believe that we hit, which was either this day or this day, which was Wednesday or Monday. And I believe it was last week, because I think that Monday was the price action, that bullish price action that we moved up and hit that first target. And then this is the second one. And to be honest, the way the market is moving, if we don't take out this low, as far as a close on a daily, if we don't close below this low, I believe any price down here is a good price to buy, to expect to target this area. And you would monitor that on like the 4 hour, the 1 hour, to see exactly if price is pushing higher. It takes a while for the daily to play out and show you candlestick patterns. So you want to have a bias built up from the daily and the weekly, and then you want to see it play out on a lower time frame. So we got our high marked. Let's move this red candle to our low, which is right there, this wick. The high is that wick. We're focusing on this daily candle, which is the previous one. And this purple line right here, that's where I mark my New York daily open time, because typically that's a good level to see visually during the London and New York crossover around, I would say 2 to 3 a.m. all the way to about a good 7. You will sometimes see price go back into the daily open just to grab any type of liquidity and to take people out, take retail traders typically have stop losses around that area, around that price. So it's not all the time, but it's just a good indicator to let you know, okay, well, if we opened here, had a high here and a low here, you can have parameters set based on if we break below the open, then chances are we could be heading bullish to target the previous low. If we break above, then chances are we could be targeting the highest point of the previous day. So to see what the previous daily open was, we dropped down to the hourly, and I would go to my military time of 00, and we are here, this sell-off candle. So basically we would put that at the open, which is right here, right when the candle opened. Bam. It was a bearish candle, so it opened and sold off. And as you can see, right around the London open, that's when you had price dip into it. Couldn't really retrace down. It gave a low. If you see this red line, this is the low of that previous day. This is the high. So I can tighten that in. Move this west like that. All right, bam. But what you see is the daily open from right here, this candle. You can see right around London how it kind of consolidated right around that open price. Like it left it, traded back into it, didn't continue bullish, turned around, came back bearish, created a low of the day. So that would entice a lot of people to sell as it broke this support on a smaller time frame. It didn't close below it, but it did break it as far as trading lower. So the fact that it didn't close low and it also didn't close below that previous bullish candle, that was somewhat of an indication that we could be continuing higher. Maybe it's not time yet to trade lower right now. So, and as you can see, the market moved higher, and also at 6 a.m. price kind of dipped down. It didn't touch the open, but it did dip into that zone. So if you was up that early, you could have caught those buys. But nonetheless, you had 7, 8, 9 o'clock of buys. And as you can see, this 9 o'clock candle did create the high. And from that point, no price ever closed or touched or ran past that high. And market been selling off ever since. And that was like 10 a.m. on Friday. And as you can see, market sold off. And where did it stop at? Stop right at that daily open. Right around close to where New York closes. And we didn't break that or that old low from the daily open. We didn't break that until Sunday, which is an hour ago. It's 7, 8 p.m. or 6, 7 p.m. if you're looking at Central Time. I got these markets tied to New York time frame. So as you can see, it says it's 9 o'clock on this candle, but Central Time 8 o'clock. So nonetheless, it's just something that I want to look at what New York looks at. So I set it to that time zone. But nonetheless, we are here on Sunday. Market open right here, right up in here. 5 o'clock. And like I said, we had no bullish continuation from market open. We had a little indecision candle right when market open, and then another sell-off. And that's pretty much where we at right now. So like I said, this target is still something I'm looking at. And on the 1 hour, it looks, so you can see, bam, it's this area right here, these double highs. And targeting all that liquidity up there. Trying to see if I can find any more double highs that got liquidated. This could be one which it did get liquidated because this is our that previous daily open. previous daily high. So that could be one. These and that's pretty much it. And as you can see, both of those areas I showed you on the 1 hour, all that price got taken out, filled in the type of gaps right around Friday, pretty much. Thursday, Friday. Because this is where the change of market structure will happen if we closed above. So that's why I said I was marking these little wicked areas that touched up and couldn't break higher right in this area. So I was like, yeah, market should eventually try to come up in here and possibly even go above here. Because we have a gap right here, but price didn't fill the gap, but it did tap into it right here and then sold off. So that would have been a good selling point from here. But we still have more of this gap to fill. And then we got another one right here from this high, this wick high, and this wick low. All this price in here is just like a gap. So overall, like I said, we just waiting now. If anything, we could also be primed for continuing the bearish trend that we've been in since April. And yeah, this is the highest point of the year. So it would have to break this double high, which is another good area I could mark up. So y'all remember this in the future. You look at this and you realize this is another area that price can tap into. You know, we got a big ass gap right here, so this one looks real sweet. If we push higher and break this, I'm not gonna put a guarantee because nothing's guaranteed, but it's pretty much a 95% chance that price can come up here. If we break through this yellow line and tap into these higher areas and fill all this clean traffic, all these gaps, it's a heavy chance that it can run into this price. If the bulls and the market starts to show signs that we can push higher, you know, that all ties into interest rates and how countries are trading against each other and yada yada. So you really got to be tied in and focus on what the United States and what the Australia economy is doing. And you can make your decisions based off that, tied in with candlestick patterns. So shit is very easy when you have patience and give yourself time enough to get comfortable with your trading pair, because you can make enough money and enough could turn into a lot off of one trading pair. You don't necessarily need to look at all of them. Nothing against the people that do, but I focus on the Aussie and it treats me well every week, as long as I treat my my trading decision on my trading strategy. As long as I follow the plan to the T and stay disciplined, yeah, I'll be good. And not only that, to throw in a little bit of risk management, you know, that is key, because when you send all your soldiers out for war and they get their ass whooped, there's less chances for you to regroup, rethink, restructure, and send your next wave out. So you got to be mindful of your soldiers, which is your bank account balance. You don't want to risk too much. You don't want to throw too much out there, because when you lost on certain trades that's heavily risked, you can end up losing 20-50% of your account in one trade. Now, losing 20% or 50% of your account in a quarter of the year, like 3 months, a month or two, that's not that bad, but if you lose it in one trade or one day, then yeah, chances are you're extremely over leveraged. You know, a person that loses 50% of their account over a 3-month span, that's mostly just a person that just you know, their trading strategy just not working out. They possibly not over leveraged. Maybe they're leveraging correctly and using risk management procedures. They're using that correctly, but over time, the strategy just not in line with what the market is doing. You know, the market could be trending and they got a consolidating strategy, or the vice versa. Market could be consolidating and they got a trend following strategy. So once you realize that, you got to adjust to whatever the market is giving you, you know, and trade accordingly. So it's always good to try to develop a strategy that can somewhat work in any type of market that we are experiencing. But if not, you know, you have a setup that follows trends based on pullbacks. You have a setup that, you know, gets you in at the highest and lowest point based off of consolidating markets. And also another key thing, you need a strategy that'll keep you out the market when you don't see nothing. You don't see no trends, you don't see no consolidation to where it could get you in within your time allotted to trade, because, you know, you're supposed to be sitting here in front of the computer 24/7. You know, you need to have a life and do other things. But if you allotted yourself to be here for an hour, 2, 3 hours, and you don't see nothing, then you need to have rules set in place to allow you to be mindful when it's not a setup presenting itself, because you can make a setup, you know, in your mind. You know, that's easy to do, but if you're not following something you back tested, something you believe in, something you know that works consistently, then yeah, you'll be in a situation where you'll be changing your strategy every week just because you Googled something or you saw something on YouTube that everybody says works. So you got to keep in mind with you find something that works well with your personality, because at the end of the day, that's what trading is going to pull out. It's going to pull out the best and the worst out of your personality. So if you are a high stressful person or a relaxed person or whatever, all that's going to get tested when you trade. And it'll show based on how much damage you did to your screen on your laptop. You know, some people are punchers. You know, they get mad, they like to punch shit. They'll punch their screen on their laptop and be assed out. So you got to control that shit, man. And that's where, you know, risk management, psychology, and all that comes into play, so you won't be putting all your money out there on several string of trades that just not working out, and you have no idea why they're not working out. And typically when you don't have no idea why it's not working out, it's because you don't have a strategy with rules. You just look at it like a job, and once you clock in, you got to make money. Like, nobody goes to a job in hopes that they possibly go get some money. Like, you go to a job because you know you agree to an hourly rate, and you know you go be there for 8 to 10 hours, so you can add up what your check pretty much supposed to look like. You know, as far as trading, you don't know. You don't know how much you're going to make until the month is over with. But over the years, you'll have a good outlook on what you can expect to make on average. And, you know, you can go from there. But that's why it's so important to, you know, take some time to review books and YouTube videos speaking on psychology and how your mind frame is supposed to be, and different things you can do to free your mind and clear your mind, you know, to prepare you for that morning. whether it's exercise or music or reading or whatever the case may be. But, just don't get too caught up in the fact that just because you're sitting in front of the laptop and you are a trader, day trader, you are supposed to be trading. Because you only take action into the markets when a setup presents itself, not when you set up in front of the damn screen. Because I'm going to tell you like this, I've been doing this for like 5 years strong. And it's not a good feeling, to sit in front of the laptop and sit and wait and you don't see anything. And then you just force a trade. And you forced it. You didn't see your setup. And then it starts to go against you. But in your mind, you feel like, hey, I'm going to hold off on it. I'm pretty sure it's going to go in my direction, but I don't want to get out too early. You start coming up with all these scenarios on why you was right, why you should have taken that trade. And then you end up, losing. And a person that has that mentality, the first thing they're going to do is revenge trade. So you took a loss, you go find another setup that's bullshit. And you probably going to increase your risk so you can win and make back the losses from the previous losing trade. And, 9 times out of 10, you're going to lose that one too. And then if that continues on, then you'll have a string of 5 to 10 losses. Or potentially you blow your account depending on how much leverage you got. So it sucks, to be in that situation and continue to do it every week. But once you train yourself that it's okay to have a day of sitting in front of the laptop and not seeing it, and you are okay with that, and you realize that that's a part of trading, then you'll be better prepared, for whatever the market is going to throw at you, whether it's a losing trade or a winning trade or a break even. You won't be so strung out emotionally on the outcome of the trade because you already went into the setup or the trade with a predetermined, result. I'm either going to lose, I'm going to win, or I'm going to break even. And typically the way you want to think is you either go lose small, you go break even, or you go win big. You always want to have a risk to reward. 1-to-1 is good, but you want to, shoot for the 1-to-2s, 1-to-3s, 1-to-4s, yada yada. And the best way to do that, in my opinion, is try to find setups or train yourself, like backtest, and only take setups near a confirmed support or resistance, or where price is just struggling to break through a previous reversal. Sometimes a reversal, if you look back in history, it may have been the first reversal of what you see on the charts as far as what the candles are putting out. Like, for instance, price is selling off, and then we have somewhat of a reversal where price started to trend up. Like, one could say this is the first reversal I saw, but until you go back in history and you could kind of pinpoint where else did the market turn from that area, and then you could see here, kind of here in this zone. So you could kind of develop like, okay, this is somewhat of a supportish zone, and price came here, couldn't break lower, then price came here and couldn't break lower. So this would be your best part, your best area to take a trade, to have your risk to reward and in your favor, because you easily could see where your stop loss would be under the swing highs, under support, and then you have several targets. You could target here, or even this high point. a take profit, and as you can see, price ultimately went higher than that. But that's how you look for a good risk to reward ratio. Thanks, Scully, John. Yeah. Scully.
What's happening, fellas?
Man, what's poppin', man? I'm over here just running my mouth. You already know.
Yeah, man, chilling, tuned in.
That's what's up, man. Right? How was y'all drive back?
It was straight, man. It was cool.
That's what's up. But yeah, man, that's the best place to look for a good risk to reward situation is. I mean, honestly, that's all I can say. I mean, granted, you know, if you buy, like, say if you buy from here, I could say that's a bad area to buy from only because you got this recent high and price could easily just not break this high and turn around. So, and they got targets like right here. So you would, to make this trade work, you would ultimately have to put your stop loss below here because it has the potential to at least to go to this low. So you want to put your stop below. So if you buy here and your next take profit is pretty much right here, you kind of got like damn near like, you know, a very risky trade. You know, you want to be risk averse. You don't want to put on too much risk and find trades that's too risky. You know, over time you'll be able to determine like, yeah, I've seen this pattern, something I know it's going to push higher. It's in the morning, you know, maybe it's coming from news or whatever. You'll develop all kind of little situations on why this is a good buy, you know, based on, you know, candlestick patterns and how they develop and how structure develops. But nonetheless, if you did buy from here, the risk to reward is all through it all. Granted, the trade did work out, but it's not as good as if you wait for this situation to happen. Don't get into no buys, but you also wait for the trade to come back as close as possible to this low. Because if you buy it right here and you put your stop loss, you know, even if you put it below here, granted, depending on where you would have got in, you know, it's a possibility you could have been stopped out. But if markets start to push higher and it didn't go any lower than this, then you could add to the story that, okay, market did push lower, didn't close below. So maybe this push lower was just to take out people's stop losses to go higher. So if you were in this area, missed this spot to buy low at, then you could still buy up here knowing that we already took out lows, we already took out stop losses, we already grabbed liquidity. So with all that added to the, you know, to the truth of what's happening, then 9 times out of 10, I could expect market to be bullish. If it turns bearish, okay, cool, I was wrong. Simple as that. It's not like, you know, I don't know what I'm doing, but any trade you take, you already got to know that it's a good chance I could be wrong. You know, you want to put it as much in your favor to not be wrong, you know, with risk to reward, only taking trades in highly volatile time zones or sessions, trading sessions, you know, other things that you can do to help set yourself up for success when you're looking for a setup. You know, you need to utilize that and read the story that the market is telling you, because that's all it's doing. Like, it's painting a picture and writing a story of greed. That's all the market does, is writing you a story of how greedy people work and how people work to trick you out of certain situations. And if you start to look at it for, I'm not, you know, on a bias of I'm not gonna fall for the okie doke, if you start to look at it in that type of mind frame, then you'll be way better off to handle a loss. You know, not to say you've fallen for things when you do lose, but at least you would be like, oh, okay, I see what they did. because in my eyes, a loss is nothing but another potential for you to get in if it's that type of loss. And what I mean by that is, like, say for instance, you did take buys right here for whatever reason. You took a buy, maybe off this pin bar right here. You saw this whole wick situation didn't close below after it came down, and maybe you bought that, and then price came back down, took you out of your stop loss down here, but didn't continue lower. So not only did it take your stop loss, but it's starting to trend back higher. You could get back into that buy. If you bought here and it went up but didn't hit your take profit up here, and it came down, stopped you out already, but you noticed that the next candle started pushing bullish, and also the candle after that started pulling bullish. Yeah, have that confidence to get back into that buy, put your stop loss underneath the low, because if it turns around and go lower, then now the story is starting to say, okay, we create lower lows, because we had a low right here, and we came down, had another lower low. So if it came down and take out this low, then now it's another lower low. So that's a story of the bears are in play, because they create lower lows. So as I said, you just look at it like a story getting written out and getting created, and you can read the past and read the history and have a better outlook on what the future is going to look like. And that's pretty much it, man. You know, overall, as far as like psychology, man, you just want to, be in your right mind, and don't put yourself in the situations where your psyche is going to be challenged too much. But that takes time and reading books about mistakes from other traders that they made, and yada yada, and all this and all that. So my first year, granted, I did a whole lot of analyzing the markets and reading and following other people that did this before me and asking questions. So not to say that didn't limit my ability to lose, but I was damn sure more prepared to take a loss, and I understood, like, okay, I took that loss, but this Forex, this day trading still works, because as I took the loss, somebody else won. So that's how I always looked at it. Like, I took a loss, somebody else won. So it ain't like you take a loss and it goes into the dungeon of forever and you'll never be able to find it. Like, nah, somebody else got your money. So you always want to be like, damn, okay, I took that L, but I want to train myself and be more focused so I can be the person that's taking all the money from all the newbies. Because every week it's a new person putting money into a trading account, whether they've been doing it for years and they keep blowing accounts, or they just got wind of this whole day trading and Forex thing and they about to drop some money. And 9 times out of 10, which I've pretty much heard in every story, everybody's first year or two max is going to be filled with a lot of, defeat, losses, trial and error, trying to understand their spot in the markets with a strategy that fits their personality. Like, all that, you gonna take time to do that, because I could sit here and tell you, like, hey, do this, do that, do that. But we are humans, and humans like to be creative. So we like to have something, learn something, but still also tweak it to where if any opportunity or any chance came in the future to where somebody wanted to get you to explain how you trade, you could say, like, yeah, I learned it from this, I learned this, but I tweaked it into my own way. So this is my strategy per se. This is how I trade. So you just got to give time for that to happen, because it will happen. Like, nobody is fresh out the gate killing it. If you are, chances are the market is in a bullish trend, and all you doing is clicking buy. And any trader had a year like that, yeah, that was luck. And don't think that every year is going to be going up. because every session doesn't trade up, every day, every week doesn't trade up. Like it's ebbs and flows with this. It goes up, it goes down, it kind of chills, it jumps around crazy fast, it tricks you out. Like it does a lot. If it was super easy, just going up and down like a zigzag, then everybody had Ferrari, so that's not the case. So you have to realize you're gonna pay the toll, man, when you riding on these day trading highways. It ain't just a free ride. So with that being said, we're gonna take a little quick glance on the news for the week, just right quick, so I can see what's popping, because you already know what's popping on Thursday. Y'all know that. So Monday, no news. So whatever the market is doing, whatever orders are in with these hedge funds and these central banks, whatever orders they have, that should still play out for Monday. If we don't have any news changing the flow of the market, or the flow of money and economics, if we don't have none of that, then we should see a continuation of whatever the banks have in play from Friday and Monday. That should continue on all the way into Tuesday morning. And that's when we have our first set of news. We got this could be like 10 or 9 o'clock in the morning, depending on my time zone I got on this. And yeah, it's 9 o'clock Central Time. So we got Tuesday morning news. We got Tuesday evening news for Australia. We got an inflation rate coming out on Australia, so that should push the market around quite a bit on that Tuesday. Wednesday morning news again, 7:30. Oh my God! On Wednesday we got a Fed rate decision. And
what does that usually mean with the Fed rate decisions?
Don't trade. If you do have a trade from the morning, like say you was getting into some trades and you in profit, or whatever the case may be, you're in profit, you down, you at break even. What I've seen in my history, and Jacob attested to this too, if you holding a trade around Fed interest rate decision or anything like the non-farm payroll, typically the market gonna move so sporadic that any stop loss you have is gonna get hit.
Okay.
So it's not good to just use the Fed rate
to better to hold where you at and get out.
Yeah, like get out. Like say the Fed rate, they gonna have they news at 1 o'clock, 1300. This is New York time, so Central Time be 1300. And if you in a trade by noon or 11 o'clock, you should take off 80 to 90% of that trade if you want to, or just close the whole thing out.
Okay.
Yeah, don't leave all your risk on, because you will get stopped out. Like, the only positive is the interest rate could push more into your profit. So if you buying, maybe the Fed interest rate could push the market even higher, and you making money, but
you might make
you don't want to get too used.
It's risky though.
Yeah, it's risky, and you don't want to get into catching a lot of profitable trades like that, because in your mind you'll develop like, oh, this is how you're supposed to trade. Like you wait for the news. You wait for the news to come out.
You start picking up bad habits and stuff like that.
Yeah. You don't want to win wrong. Put it like that. You don't want to win money or make profitable trades the wrong way, because all it's gonna take is that one wrong time when you already up $100,000.
You scoop it. And you blow it. You done scooped it before, so you think you gonna scoop it again. And you drug that whole account 50% in one day.
Facts. And that's the worst thing when you up $100,000 and then you lose 75 grand. Like, yeah, like that'll kill all your motivation. But
Gotcha.
that's why I stay away from that.
And see that question kind of came from listening to you earlier when you were talking about like risking the account, within days versus over a month time span.
Yeah.
Gotcha.
You want to utilize heavy news decisions, and this only come from just seeing this, because as you can see, all these news releases are high. So when they say high, that means they got a chance to really move the market and make it continue lower, continue higher, or do whatever they want. But it's a lot of volatility that's going to come into the market off these high news releases.
Right.
But out of all these releases, this interest rate and this Fed press conference, that's the shit that's going to really move. Because all he going to say is, we increasing rates, we decreasing rates, or we not changing nothing. And
that's when everybody starts to go on whichever way they feel like going.
Yeah, and it's the banks, it's the central banks in all the different countries, it's the hedge funds, all the big people that's moving like trillions of dollars. That's the ones that's going to put their orders in to move the market around, and it's going to be crazy.
Right.
And you want to just utilize that news release to tell you where the market is going. So you just sit back on the sidelines, let it do its thing, and once you start to see it push higher, then all you got to do is wait for it to come back down, do a retrace, come back down, so you can get into a buy.
Okay, gotcha.
So to speak. So if we look at it on the well, let me see what else we got for the news. I think Thursday, of course, jobless claims, continuous jobless claim, that come out every Thursday of the week. And then Friday, we got some personal spending, Michigan consumer sentiment, yada, yada, stuff like that. Friday is really kind of dead day anyway. But like I said, for instance, on something like this, if this was the news that pushed the market higher, like say, for instance, this right here, this whole little drop down and turn around, that was the interest rate and everything pushed higher. Your best bet is to wait for price to come back to this area where it pushed from to catch another buy. Now, if it break lower than this area, which it did, then you got to wait to see, okay, is price going to break this recent lower high? Because if it breaks this high, then we continue in higher. Chances are. If not, if we go this high and if it starts to hesitate right here, then I could continue lower. Only because we broke this low right here.
I think it's still got the news up still.
Oh shit, you're right. I've been talking like a bit. You're right. I didn't switch it.
You good.
But yeah, so I was just talking about this low from here. If the news shot up, then you will want to wait for a price to come back down to this area before you look for another buy.
Right.
Granted, this buy was kind of weak. It was still a good trade, but it was weak because this is Friday. So Friday is not a good scenario for this type of setup. You want to wait for the following week for Monday to play out. And a good reason for that, because on Sunday, as soon as the market opened, we broke that low for Friday. This is the lower Friday, which is my red line right here, this wick. That's the lower Friday. And we broke that on Sunday, like 3-4 hours ago. So now the best thing for me to do is like, okay, I feel like the continuation is going lower. So we possibly are going lower because we did break this low. But I can't be too sure until I see a continuation lower, or if it pushes higher, that it doesn't break this high. And when I mean break, I mean like break it and close above it.
Right.
And I would utilize at least a 1 hour for something like that. So this is that area right here on the 1 hour. I will wait until the 1 hour breaks that area and closes to cancel out the fact that we could be breaking lower. Now, that's not 100% sure cancel out, but If we closed above here on the 1 hour time frame, chances are we could be potentially going higher. But if we tap this area and price wicks up here, but we closing below, and we waking up, but we closing below, then chances are this could be a prime area to take a sell to continue lower, and then it could break, lower than here, or it could come lower than this area over here. So it's just, like I said, it's all about reading the story. Like it's gonna play the story out. You just be patient enough to let it play out, let it read,
right,
and just wait. That's the best idea for all. That's why it's good. You could be a trader looking for setups on the daily time frame, the 4 hour, the weekly. You can really be patient enough to wait for that type of situation.
Right, for it to set up for you.
Yeah, like I was reading, watching a video of a guy. He, I don't have the monthly time frame, but he would look on the monthly, like a scenario like this. Like he would see, like, okay, let me use this right here. This is the weekly, but this is the week of June 9th. Oh no, that's June. June 8th through like the 11th, or like the 7th through the 11th, 7th through the 11th, something like that. So that week is a bearish week. It's red. It pushed lower. It's a bearish week. So chances are the monthly probably looks. Let me see. This is the beginning. So the monthly didn't close yet on this. It's still the beginning of the month of June. But previously, the previous month would have been, let me see, would it be bullish? It's questionable. Probably would have been an indecision candle for that month. But nonetheless, if you dip back to the month before that, it was definitely bearish. As you can see, the month of April was bearish. The month of May probably was like an indecision candle. And then June, as we know now, it was bearish. But for instance, if he knew that his monthly candle is bearish, this weekly candle is bearish, then he would go to the daily around after this candle closes. He would go to the daily and wait for a candle to close opposite of what he sees on the monthly and the weekly. So he would go to the daily around June 12th. So that was that sell-off week. And basically, this green candle, he would utilize green candles that go against the trend of selling off, the bearish trend that you saw on possibly on the monthly and on the weekly. And he would look at that as soon as these candles start to show signs of turning around on the 1 hour, that's when he would sell, because it's going in line with the weekly and the monthly, or the monthly and the weekly. And of course, the daily is, you can see as the week started, it started to push up higher. Granted, it never went high as the previous high on the daily, but it started to push up high. So that's just simple retracement. Markets do it all the time. But when you see that, you can drop down to even lower time frame, like the 1 hour, and just prep for when is the perfect time to sell. So if you look at this candle closed June 15th. So we go to June 15th on the 1 hour, which is right. Gotta go back. Like the 15th was right here, over here. So yeah, market started to push higher June 15th, and to throw a little tidbit in there, this was Thursday going into Friday. So you already know. Hold up, that's July. I'm tripping. That's July. Go back to June. June 15th. Okay, bam. This is June. So as you can see from that previous week selling off, on the daily, we got our first bullish candle. Even though we know on the monthly and the weekly is selling off, is bearish. But on the daily, we starting to see a retracement. We're starting to see it pull up. Now, the first sign of market structure change was where I would be looking to get in. If I know that the monthly is bearish, The weekly is bearish. All I'm looking for is signs for the daily to start turning bearish along with that. And I would see that after I see my first daily candle close green, meaning closing bullish, that's going against the major trend. So when I see that, you can't really tell when the market is going to turn around on a daily. So that's why you got to drop down to an even lower time frame so you can see candlestick patterns happening that can get you in early on that daily reversal. And the easiest and the most profound way to do that is to wait for a change in market structure. And the way to do that is market structure is higher highs, higher lows, lower highs, and lower lows. So for this instance, we looking for market structure to change back into going bearish, because bearish is what the monthly is doing and it's what the weekly is doing. So we want to see when the daily is going to start to turn bearish to go in line with the monthly and the weekly. And you do that by waiting to see when price closes below the last lower high. And lower highs and higher highs are how you determine a bullish trend. So for instance, this is the first low. This is a lower. This is a high, a low and a high. Comes back down. This is a lower high because it's higher than the previous low. It pushes up to this kind of area. This is a higher high because it's higher than the previous high. Then it kind of comes down. You can see a little dip down. This is a lower high because it's lower than the previous low, or the previous low. So it's a lower high because you're going higher. So it's either higher high or lower high. And you got up here another higher high because it's higher than the previous high. And it comes back down, retraces, and now we got a lower high because this lower high is higher than the previous low. So lower high is higher high. What you want to do, you want to wait until price closes below the most recent lower high. So the market could be going up, creating all these higher highs, lower highs, and you want to wait for when price breaks that. And as you can see, price broke it right here at 10 o'clock in the morning. Now, you could either enter right as price closes or starts to go below that, but who's to say that this candle would have went down but closed up here and you would have had a big ass wick? We don't know. So that's why it's good to wait for the candles to close. So you can wait for the candle to close, which it did, and it closed all the way down here. So like, bet, all right, I got my first change of structure that closed below the most recent lower high. So after you get that, you could take a sell right here because where your stop loss would have to be way up here. And that's what I was talking about earlier with that risk to reward. That's like not a good setup because you basically buying at the low and you got your stop loss way up here, and price could easily retrace up there because they know, banks know, hedge funds know, central banks know, all these big, great traders know that retail traders, everybody that's starting off, they taught to put their stop loss if you in a sell above the recent high, the most recent high. You know, a lot of people teach you to put it, you know, above the most recent candle, the recent high of the candle, which would be right here. But as you can see, that got stopped out. So nonetheless, either I would, you can back test this to see how it works out in the past. You know, look at other trades that had the same scenario in history, and you can see, like, is it best for me to take a trade as soon as it breaks through, meaning I'm gonna take a trade here as soon as it breaks through, or I'll wait for a close and wait for a retracement. So as you can see, if you would have waited for the market to retrace it retraced way up here, but as you can see, it didn't go as high as here. So if you would have had your stop loss up here, so far you good. And market started to turn back down. Then it came back up, scared a lot more people out because a lot of people had stop losses right here, and probably right here. But if you did, like I said, this is the first level to have your stop loss if you would have sold down here or right here. Nonetheless, it never got hit. And as you can see, markets start to reverse again, start to go back bearish. You could put your stop loss here. And as you can see, never got hit. But one thing you did see is markets start to continue down and down. Never went back up to the stop loss. Started selling off throughout the whole week, selling off. So, and the only reason it started to sell off so strong as it did and started just continue lower and lower is because it's going in line with the monthly, the weekly, and you took the time to have patience to wait to see when the daily was going to go in line with the monthly and weekly. Like I said, you won't be able to see the daily reversing per se just by looking at it because you got to wait fucking 24 hours for the daily to open and close. And, you know, that's just really not the proper way to trade. You want to see like, okay, my monthly is bearish, my weekly is bearish. I'm going to wait for the first bullish daily candle because I know it's going against the trend, but I'm expecting the trend to continue, and I want to see when will the daily flip. And you only can see when the daily will flip on a smaller time frame. So that's why I went to the hourly, and I showed you the best way to look for a market to flip and continue in a trend is to wait for it to close below a structure point, a lower high or a lower low, or a higher high or a lower high. So it's always good to just recognize structure, like what did it close below and what didn't it close below, or what it did close higher or what it didn't close higher. Because when markets don't do something or they do something, that's always a telltale sign of what it's gonna do next. It's like saying somebody, you know, it's like somebody about to go into a party and you know the party's supposed to be, you know, turned up, but you drop them off and you never see them go inside. Like, why they not going inside the party? The party's supposed to be lit. It's supposed to be fun. Maybe they know something you don't know. Maybe they just got a text message that somebody about to start shooting in the party. You know, like it's a reason. It's an indication to let you know why something not happening. You know, in line with what it should be. You know, the market going higher, it should be going higher, but it didn't. Damn, why it didn't go higher? Okay, maybe it might be turning around, but for me to know that it's turning around and going lower, it has to break a previous low point, like right here. Like, I wouldn't know that this market was going to keep going lower unless if it broke this low. If it never broke this low, like it could come down and just stay right here for all kind of days. But I'm gonna just be sitting here waiting. Like, it didn't break the low. It didn't break the low, so I can't take sales yet because I don't know what's gonna happen. You know. So, like I said, it's just reading a story, man. That's all it is. And if you look at it like that,
you're on fire today. You're on fire today.
Nah, big facts, bro. Just breaking it down, and it wasn't too much any major setups that I've seen. I mean, if anything, it was sales, but, you know, that's kind of continuing from what it did on Friday from this high, you know, kind of sold off, continuing to sell off. And based on the open of Friday, this was the low, which was a higher low, because this was a low. This is a low. This is a low, and then we going higher. So these lows are higher than the previous one. So those are higher lows. And as you can see, market broke that structure. Higher lows, higher highs, lower lows, lower highs. That's all structure. Market broke structure. So as of now, and to go with what we've been talking about these past 2 weeks, I'm thinking that the market probably will continue to sell off like it's been doing since April. Like I said, we won't see any bullish type of momentum until we close above this on the daily. So I would see market will have to push higher and close above here for me to see that, okay, the bulls are strong enough to possibly take this market even higher. But if I'm gonna be smart, I'm gonna go with what we've been on since April, and we've been on sales. So trade what you see, not what you think. I see sales, so I'm gonna expect that market is gonna continue selling off. So with that being said, that's how I would play the Australian dollar for everybody looking out for this. Other than that, the market will be jumping around crazy, especially on Wednesday, like we talked about in our news release. So y'all play it easy, keep it cool on Wednesday with that fair rate decision. Don't put too much risk out there. Yeah, watch the previous videos and keep learning, because we're gonna keep dropping in knowledge.
Big facts.
Big facts. And we about to wrap this one up. That's another one in the book. Oh, and also this is the end of the month too, so keep that in mind. Look at the monthly time frame, look at the weekly time frame, just so you can kind of have an idea on how you could expect the market to close. So keep that in mind too when y'all trade. This is the end of the month. We do have another month starting, and we are starting to dip into the end of the holiday months. October, November, December, September.
That's when certain stuff gonna be spiking, going
Man,
up. Certain
come on, bro.
Going down. Them people start to spend their money.
And I'm gonna be honest, bro. Like this summertime that we've been trading, it's supposed to be the slow months, but as you can see, it's been a lot of.
It's been moving. So imagine what's gonna happen later on in these holiday seasons.
You already know it's about to be get money season, so
yeah,
be prepared for that, and you gonna see new structure, new changes, new dynamics in the market that you probably never seen if you ain't been trading that long. So
all the market, how the market's been going, inflation and different things that's been going on this whole year.
Facts.
This end of the year stuff gonna be different too.
Big facts. This is all new terrain we entering in. So just keep that in mind when you trade, and y'all know if y'all got any questions, reach out to us. But like I said, we about to wrap this one up, and we gonna have a relaxing Sunday, and we'll chop it up with y'all on the chat on Monday, man.
Yes, sir. Be safe.
Nicely done, fellas.
All right, man. I'm gonna holler at y'all, bro. Y'all be good and positiveness.
I miss you this week, bro.
Big blessings on everybody's pockets.
Yes.
Yeah, we did miss you this week, We did. We're gonna have to link up next time.
Oh yeah.
We're gonna have to do something. Yeah. But
yeah, we will. All right, y'all.
Yes, sir.
Holla at y'all. Peace out.